Spring 2020 brought chaos, stock markets crashed, U.S. unemployment soared past 14%, and global economies froze as the pandemic shut everything down. Shops closed, supply chains broke, and fear gripped households. Many believed Keynesian economics, government-driven spending to boost demand, was outdated and dangerous, bound to produce only debt and inflation. Yet by 2025, the story flipped. Jobs came back, growth surged, and markets soared. What seemed Keynesianism's last gasp became its stunning revival. Nearly a century after John Maynard Keynes proposed bold government intervention, his ideas again guided economies through darkness. Keynes forged his theories during the Great Depression, when mass unemployment and stagnant demand crippled economies. His insight: if private spending stalls, governments must step in. Public works, welfare, and tax cuts could spark demand, multiplying through wages, purchases, and production. Critics warned of deficits, inflation, and crowding out private investment. Yet history offered support. After World War II, government-led spending fueled decades of growth in the US, Europe, and Japan. Investments in infrastructure, education, and social safety nets built prosperity. Keynesianism became the blueprint for crisis response, even as debates over its long-term risks persisted. The 2008 financial crash revived Keynes's playbook. As banks collapsed and unemployment rose, governments intervened. The U.S. launched an $800 billion stimulus, funding infrastructure, industry bailouts, and tax relief. Other nations followed with similar fiscal and monetary action. Critics decried reckless debt and predicted inflation. Instead, jobs and growth returned within 2 years, while inflation stayed low. The intervention broke the downward spiral, proving Keynesian measures could stabilize modern economies. The 2008 rescue was a rehearsal for an even greater test ahead. The pandemic delivered a double blow, both demand and supply collapsed. Lockdowns closed businesses, airlines grounded planes, and millions lost jobs. Governments responded with unprecedented Keynesian force. In the U.S., Congress approved over $5 trillion in relief, direct stimulus checks, forgivable loans through the Paycheck Protection Program, and extended unemployment benefits. Europe rolled out job retention schemes like Germany's Kurzarbeit. Central banks slashed rates and launched massive bond buying to keep liquidity flowing. Deficits soared, inflation spiked, and critics warned of disaster. But while grocery and fuel prices rose and debts piled up, these interventions prevented collapse. The system held, and recovery began. By 2025, recovery looked extraordinary. U.S. GDP grew at its fastest pace in decades. Unemployment dropped below 4%. Consumer confidence surged as households spent stimulus money and businesses expanded. Europe avoided feared mass layoffs, and global supply chains healed. Inflation moderated as central banks tightened policy. The multiplier effect was visible everywhere. Unemployment benefits boosted retail sales, which increased factory orders, which created jobs. Government spending had reignited private demand. Entire industries stabilized, while sectors like technology, healthcare, and renewable energy thrived. Critics still worried. Debt levels ballooned. Benefits often flowed disproportionately to asset owners, widening inequality. Stock markets hit record highs, enriching investors faster than wages rose for low-income workers. Yet without intervention, the alternative might have been catastrophic: prolonged depression and mass bankruptcies. The Keynesian revival revealed clear investment lessons. Cyclical stocks thrive, especially in construction and consumer sectors. Infrastructure projects create contracts and jobs. Retailers and automakers boomed as households spent relief money. Companies like Home Depot, Walmart, and Tesla benefited from the pandemic recovery. Heavy government spending often lowers yields as central banks suppress rates, but inflation fears can drive yields higher. Announcements of stimulus packages spark equity rallies, hints of deficit risks or tighter monetary policy create volatility. Excessive debt can spook markets, pressure currencies, and widen inequality. Gains often favor large corporations and investors over small businesses and workers. For investors, the lesson is balance, diversifying into both cyclical growth stocks and defensive assets like gold or utilities. Massive spending rescued economies but left daunting debts. While inflation eased by 2025, it remains a long-term risk if shocks return. Wealth inequality worsened, showing stimulus alone cannot fix structural gaps. Keynesianism also risks political misuse. Spending programs may be designed for electoral gain rather than economic efficiency. Poorly targeted checks or infrastructure projects can waste resources. Still, the pandemic showed Keynesian tools work. The mix of fiscal stimulus and accommodative monetary policy restored growth when nothing else could. Climate change, aging populations, and automation demand fresh applications of his ideas. For now, the Keynesian comeback proves the enduring power of bold intervention.